Sugar Daddy and Investment Life bring you freedom of financial.
Okay folks, let me break this down for you. The stock market took another big dive today, just like I called it earlier. The whole thing's heading for at least a 10% pullback. This ain't some surprise, it's a build-up of a bunch of factors. Let's unpack it step by step. First off, think back to that rebound a few days ago. That was mostly folks getting pumped about the US government shutdown ending. Based on the latest numbers, on November 10th, the S&P 500 jumped 1.54% to 6,832.43, and Nasdaq shot up 2.27% to 23,527.17, led by AI stocks like Nvidia and Palantir. But here's the kicker. That rally kicked off even before the government officially reopened, pricing in like 2% ahead of time. I was kinda scratching my head because the policy wasn't even locked in yet, and the market was already acting like it was all sunshine, ignoring the risks. Sure enough, once it happened, profit taking kicked in hard, cash started flowing out, and prices got yanked back to reality. In terms of percentages, the S&P 500's already dropped from its recent highs, and if this keeps up, it could dip down to around 6,200. That's like another 5 to 7% downside from yesterday's close at 6,737.49 on November 13th, which was down 1.66%. We'll dig deeper when it hits that 50% Fibonacci retracement level, but short term, I figure that 5% buffer is a fair shake. Why's the drop so brutal? Two main reasons, and I'll dive in with some examples. Number one, recession fears are heating up. With the shutdown dragging on, key econ data like jobs reports and GDP estimates got delayed. When they finally drop, folks are betting they'll be weak, like non-farm payrolls maybe only adding 10,000 jobs, way below the expected 15k, and unemployment ticking up to 4.2%. That amps up worries about the economy not sticking a soft landing, sparking that risk-off vibe. For instance, back during the 2023 shutdown, the S&P dipped 3% short-term, and consumer stocks like Walmart slid 5% because consumer confidence tanked right along with it. Number two, valuations are way overinflated and need a reset. A ton of growth stocks, especially in AI and tech, went nuts on the upside, blowing their PE ratios sky high. Take Palantir, its PE is sitting at like 400 to 500 times, miles above the industry average of 30 to 40. That means the market's baked in super optimistic earnings growth. Same deal with Nvidia at 50 to 60 times PE, and some quantum computing plays like IonQ or Rigetti tanked 30% in a single day, wiping out a third of their year-to-date gains. These guys are growing fast. Palantir's Q3 revenue jumped 30% year over year, but it still doesn't justify the current prices. This valuation fix is basically the market snapping out of hype mode back to sanity, kinda like the 2022 tech bubble burst when Nasdaq pulled back 25% and high PE names like Zoom got cut in half from their peaks. So what's next for the market? As long as no black swans pop up, like a spike in shadow banking bad debts or some geopolitical mess, I think a 10% pullback's enough to shake out the excess. Why so upbeat? 1. We're still in the Fed's rate cutting cycle. December meetings likely to drop another 25 basis points, and next year's first half could see 75 to 100 basis points total that eases borrowing costs and juices up business spending. For example, after the 2024 cutting cycle started, the S&P climbed 15%, with tech leading the charge. 2. The government's got about $800 billion left in the Treasury account to pump into the system, boosting liquidity, just like the 2021 stimulus when that cash flood cranked M2 money supply up 20% and fueled the rebound. On specific stocks, barring any shocks, Tesla could test support at $380, closed around $400 on November 13th, down 7.43%. That's near its 50-day moving average. Nvidia, NVDA, might slide to about $160 from current $191, eyeing potential support, and TSMC could oscillate in the $60 to $70 range. These levels aren't just technical, they're valuation sweet spots, like if Tesla's PE resets to 60 times, it'll better match its EV growth outlook, expecting 25% annual deliveries by 2026. Investment advice? Don't rush to bottom fish. Wait till the index fully pulls back 10% before building positions. It's not hesitation, it's smart risk management. After all, short term, tomorrow or the next day, there could be more bad news like crappy inflation data piling on, If you're already holding quality names like Apple or Microsoft with their solid cash flows and moats, the paper losses, 10 to 15% short term sting, but long term, it's a golden chance to add shares cheap and supercharge returns when the economy bounces. Remember Buffett's line, be greedy when others are fearful, but only if you've got dry powder. Keep at least 30% cash on hand, just in case. Bottom line, this pullback's a healthy reset, not doomsday. Stay disciplined, stick to fundamentals, and you'll rake it in from the bottom.
Please subscribe and follow New York Daddy Investment.